The best of Money Matters.
Market View on Money FM 89.3.
That's right, you're listening to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors and companies to watch. But as always, a quick recap of how we started. Well, Singapore equities began the day in the green, tracking gains in global markets. So in early trade, the Straits Times Index was up 1.2% at 3,816 points after some 41.7 million securities changed hands in the broader market. Now let's take you through the closing numbers. The STI closed up 0.76% at 3,801 points. In terms of value turnover, that's 1.02 billion Sing dollars. Gainers outnumbered losers, 326 versus 168. Top advances for today, we've got here UOB, DBS, OCBC, VentureCore and SGX. And top decliners for today, we've got here GMXUSD, Jardine Cycle and Carriage, Aces, Plato Capital and Hotel Royal. Now, in terms of companies to watch, we do have our national carrier, Singapore Airlines, because the airline and its low-cost arm carried a total of 3.6 million passengers in December last year, up 7.1% from the previous year. Now, elsewhere from how Asian markets reacted to healthy U.S. bank earnings and a below-forecast inflation print, to how Taiwan Semiconductor manufacturing companies' profit in the December quarter topped estimates. We've got more international and corporate headlines in focus. And joining me on the line on a Thursday is David Chow, Director at Azure Capital. David, welcome. How are you?
Hi, Tian Tian. Hi, everyone. Happy 2025.
Yeah, happy 2025. David, let's start with Asia this time around. A healthy day. Asian markets extending that global rally because of a couple of things. We've got U.S. inflation data for December coming in below forecast. We've got healthy bank earnings from the likes of Goldman Sachs and JP Morgan. We've also got a ceasefire deal between Israel and Hamas. So all of that adding to that positive mood on trading floors. Question for you, how would you read into investor sentiment in the region, and how long can that positive mood last really?
Okay, today we are certainly seeing, very positive, stock market actions. And how long can this last? Perhaps, until next week when Trump takes office officially. And, on reading our investor sentiment first, I think investors should, and some of them, have prepared themselves to see a volatile year ahead, for equities, driven by global tariffs, wars impacting regional trade and growth, unpredictable trade deal negotiation process, a conflicted Federal Reserve, and a potentially more hawkish interest rate outlook, which has a small dent, after the CPI released yesterday, but the overall tilt will still be towards hawkiness, and you also have ambiguity surrounding China's stimulus plan, including the size, the specifics, and the implementations. So there are a lot to get into. So we can expect, market swings as, investors' response to the unfolding Trump 2.0 policies in the coming months. With the release of positive news flow, you have stated in your questions, such as, the positive U.S. bank releases, the Middle Eastern conflict. It's not, hard for the market to take a breather, amid the negativity that we have seen in the stock market last week, to go back into the stock markets today.
I see. Now back to the Singapore stock market as usual. How did the STI fare today? Any surprises as well when we look at the biggest movers, the companies to watch like ESR REIT? It is divesting a Tuas industrial building for about 9.9 million Sing dollars. Any surprises there?
We saw the positive news flow. STI, staged a very strong 0.8% close today. And, looking at ESR REIT, share price performance today, it didn't seem to move or, react positively to the news. So if you look solely at this news alone, well, I think any divestment at a premium is generally a good catalyst for stock price. But at a premium of only, 1.5% when you account for, opportunity cost, not to mention the initial, internal rate of return target set, it seems quite low to me, and it probably revoked memories of, what this REIT did, I think in June 2023, when it sold, I think, some industry properties in both Singapore and Australia, for a bit of a discount to the combined valuation at that time. And, that time, investors were wondering whether that was a sign of financial distress. So anyway, fast forward, back to current, I think REITs nowadays are looking at the buzzword of capital recycling, and that will entail divestments. And solely on the ESR REITs performance, I think in the 3Q 24, I think its revenue and its NPI actually declined by I think about 6 to 7%, respectively year on year. I think due to the divestment of 11 properties since FY23. So I think some pockets of investors could also be worried, that this new divestment will continue to reduce, top lines for the REIT in the coming years. I don't blame them for having this thought, even as, fundamentals of this REIT is currently supported by, strong positive rental reversions and stable operating metrics. So, these are some of the things that, what is really weighing on investors' minds could really be, the divestment and its, lost opportunities.
I see. Now, from ESR REIT, let's take a look at Singapore Airlines, because the national carrier, along with its low-cost arm Scoot, they carried a total of 3.6 million passengers in December, which was up 7.1% on the previous year. Now, SIA also reported growth in passenger capacity and cargo loads in the month. How would you read into the latest developments, and how significant are the numbers when it comes down to share price movements today? Because I understand there are also some developments relating to SIA and F1.
Okay, so I think in SIA earliest management update in early November, I would say last year, management actually guided that they expect air travel demand to stay robust, heading into the year-end peak. So, the news about, their numbers are boosted by, a strong year-end demand isn't a big surprise, to say the least. And I mean, the key positive, if you look at this news from a calendar year basis, will still be decent growth in its passenger and cargo loads. But the thing, these sort of numbers are expected, and the important underlying issue is whether the yields that accompany these numbers, the passenger use and the cargo use, whether these numbers, will be stronger or weaker, because the market is expecting a weaker use, at least for the passenger side. So because these use are not known yet, so I think, we have to do a wait and see. And, what about the absolute growth alone? So in the last quarter, if you look at passengers, I think it declined, more than expected, amid again, intensifying competition in these key markets, and the PAX load factor also fell last quarter. But on the cargo side, this yield has somewhat stabilized, for a number of quarters. So healthy air freight demand is still prevalent. I think SIA will still need to closely monitor key trade lanes and adjust its capacity accordingly in view of the ongoing geopolitical tensions and macroeconomic uncertainty, which may impact global trade.
I see. And a quick one, because I just want to provide some context. Earlier, we talked a bit more about F1. So what is happening here is that SIA has extended its title sponsorship for F1 for 4 more years until 2028. Any significant impact on the share price, so to speak, or more of a
I would say on
FYI?
net basis, it should have more impact, on its marketing campaign. But take nothing away from the depressed use that, the market has forecasted to hit, SIA in the coming quarters.
I see. Now, if you're just tuning in, when I'm in conversation with David Chow, Director at Azure Capital. Well, David, let's fly over to Taiwan for some, I wanted to say oyster omelette, but for some chips. And it appears that we're always on the show talking whenever TSMC reports its earnings. This time around, TSMC's profit, Taiwan Semiconductor Manufacturing Company's profit, and the December quarter topped estimates with a 57% rise. So that gave a boost to investors who are hoping that the AI hardware spending spree could extend into this year. Now, what does it say about the health of the global tech sector looking at TSMC's results, and how far can that strong performance continue given those uncertainties relating to Trump 2.0?
Okay, I mean, as we are speaking now, I think on my screen, the semiconductor stocks, continue to rise in overnight trading. Your TSMC is leading the gain with NVIDIA, AMD, Broadcom and Micron. They are all up, I think, average of about 1.2 to 2 to 3%. And you're right, we did talk about TSMC. It seems like every time I'm on air, every quarter, TSMC will report. So okay, I'm glad to talk about TSMC. So the last time I spoke about TSMC, I said that things to watch out for will be their accelerated adoption of its 3 and 5 nanometer process nodes and significant progress in its advanced packaging technologies. So furthermore, I also said that we also have assessed the company's strategic price hikes across all these all their inventory and sustain whether they are able to sustain high utilization rates for cutting edge nodes, and because this will at the end of the day would see whether all this will actually boost its growth narrative and setting a positive tone for future earnings releases. So coming back to the just released earnings release, a strong release, no doubt about that. With revenue for the December quarter up 39% and net profit increased by 57% year on year, and these two key numbers also beat consensus expectations as well. So this tells me, in a nutshell, that it's yet another AI-driven growth, and this has certainly boosted outlook for AI this year. Despite some headwinds such as your geopolitical and mature node utilization challenges, but I think overall the market still remains optimistic about TSMC's ability to deliver on its promises. So key drivers such as the AI accelerators and cryptocurrency mining chips, along with their strategic pricing measures, should see this stock continue to gain traction this year. And with Trump coming up, of course, extra tariff will be on the weighing on the mind of the chip industries, and of course the finished goods exported from the US from selected countries, which have really could have the potential to overweight global inflation. And of course with Biden's farewell gift, inverted commas, of implementing a tiering system across countries, just last week, a few days ago, certainly adds to the uncertainty. So at this point in time, it's hard to quantify the financial impact on the tech sector when it comes to having to account for geopoliticals, given the complexity of the mechanism, which could just change overnight.
Okay. Now, David, while we are talking about some good news out of TSMC, not so good news out of Apple, because data from research firm Canalys revealed that Apple was dethroned as China's biggest smartphone seller in 2024. We're seeing rivals like Vivo and Huawei overtaking it, and that's after annual shipments in the country declined 17%. Its annual shipment in the country. So how far is that a surprise to you, and to what extent are Apple's hands tied in boosting its competitiveness in China in terms of the tech that they can provide in their iPhones?
Anyone who has spent his or her time to track some of the handset shipments in China, the writings have been on the wall, really for some time, for the China brands to eventually, beat Apple and ascend to the throne, to the peak in terms of shipment in China. But having said that, globally, Apple is still residing, I think, in the second spot, for global sales in third quarter of last year, just after Samsung. So in our conversation with investors, we did tell them, our own investors, we did tell them that we expect, Chinese top 4 handset brands such as the likes of Xiaomi, Oppo, Vivo, and Huawei to deliver a faster than Samsung and Apple, as well as global smartphone shipment growth for last year and this year, as these 4 brands actually benefit from the strong handset demand recovery in China and emerging markets. So in our forecast, we actually forecast these 4 brands to grow by 8 to 12% respectively, compared to just 2 to 9% for Apple and Samsung. So I think Apple is really not selling more phones in China, due to increased competition from the likes of the 4 key brands that I've mentioned, which actually offer comparable features and lower prices. I mean, for myself, I have actually hold a Xiaomi phone for I think the last 5 years, because of I see value in Xiaomi's phone for comparable features. So in China alone, as you know, there's a growing nationalist sentiment in China, pushing consumers towards locally made products, and of course recent geopolitical tension between these two giants certainly do not help for sales of Apple products. And to a certain extent, I think Apple's lack of significant innovation in recent years when it comes to the AI features have also contributed to the decline in sales.
Okay, and finally, before we let you go, David, Canada has reportedly drawn up an initial list of 150 billion Canadian dollars, around 143 billion Sing dollars of U.S. manufactured items that it would hit with tariffs, and that is if US President-elect Donald Trump decides to levy tariffs against Canadian goods. Now, any quick thoughts on how Trump 2.0 would really reshape that nature of global trade?
If the policies are effected, the U.S. is, moving more and more into a more, isolation, from the rest of the world. So, new tariffs could be devastating for both Mexico and Canada, and also they are harmful to the U.S. I mean, just look at the car manufacturing industry, for example. This is an industry that depends on the supply chain that is spread across the three countries. And if you disrupt that supply chain, you will have massive disruptions in the auto market. And when you have disruption, that will have potential to push up, prices, reduce demand for products, and even hurt company profits, which could in turn, drag down their investment levels or capex. And if you also look at EVs, more than 10 million, were made in China last year, and that dominance, led the US, Canada, and EU to impose tariff on them. So, while Beijing said they are unfair and is challenging them at the world, at the WTO, I think it's the prospect of Donald Trump's imposing tariff that is concerning the EU. So, ultimately, restrictions on trade, protectionist measures are not conducive to growth and could, potentially throw the world into recession.
I see. Lots to watch indeed. Thanks so much for the insights, David. That was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.